Guys, the biggest concern I have is we're recording this earlier in the week, but there could be a government shutdown this week. It looks like there is going to be a government shutdown. And apparently, if there is, we're not going to get the jobs number on Friday. Now, I called the government and said, my brother Chris, for a small fee, he'll announce that number. If the government shuts down, he'll take care of it for you. So, Chris, I got your back, man. I got you a nice gig here on the side to announce the jobs number on Friday.
In the spirit of being bureaucratic, I'm kind of hoping that if the government does shut down, we actually may get a day off for a change.
Day off, my God. Have you added up all the vacation days he's taken this year, Courtney? I mean, just like...
You never know where he's sailing off to. I know.
Man, you guys are rough today. Bob wakes up every morning saying, your time is my money.
That's exactly right. But, the big thing is that's like the big horror. Oh, my God, we're not going to get government statistics. Right. So we do get the jobs number on Friday. If they don't shut down the government, then we're going to get a revision on the last month, a month before, the quarter before. I mean, it's like they never could seem to get these numbers very, they don't report them very accurately. It appears to me.
And who knows if they've been politicized, if the number's been messed with, right? There's so much going on right now with government manipulation. Who knows what to believe? But you know what? If I'm a betting man, I'm going to say that number's not going to come in that poor, right? We've been hearing about this employment market falling off a cliff, Court, but I'm suspect right now. I actually think the labor market's probably in pretty good shape, regardless of what those economists want to tell you.
I would agree with that. Yeah, and I don't think we need the numbers to come out on Friday in order to justify that or not. To your point, I think the labor market is in good shape, regardless of the numbers coming out Friday or not. And to Bob's point, they're probably going to get revised. So I don't think you want to make any investment decisions based off the government getting shut down and or whether or not we get these numbers on Friday.
Yeah, I mean, what do you think, Chris? Is this more just political theatrics? Then we need to worry about the economy falling off a cliff because the government, and it's non-essential workers, by the way, right? It's not all workers. Not that say that government's been that efficient anyway. If they shut down for a couple of days, nobody notices.
Yeah, it's almost like the markets do better when there's the least amount of government intervention.
Yeah, but wouldn't that be horrible to be, you get called up tomorrow and go, well, you don't have to come in because you're non-essential. I mean, what a horrible way to define your living, right? What do you do? I have a non-essential job for the U.S. government.
That sounds like Ryan's title.
Well, okay. Well, then we can rename them president.
Hey, wait a second. I'm the president of this organization. So, there will be no more days off from here on to the end of the year. That's for sure. So
sounds like an honorary title.
But, look, I mean, we talk about this week after week, but right now, from our viewpoint, is you have a labor market that, again, isn't falling off a cliff, right? We're seeing economic growth. We came out with the number right now is at 3.8% was revised for last quarter. We're tracking 3.9% for this quarter in economic growth. This is well above what the economists had anticipated. Remember earlier this year when we had tariff turmoil, every economist was talking about how it's not looking good. Economy's going to slow. We might have a recession. And now we're getting above average economic growth. I don't know, Court. Things look pretty good.
They do. And I think there's been a lot of confusion because there is some data like the labor market data. People do question, are we going to go into recession because you have a softening labor market? But then on the flip side, yeah, GDP is growing. Companies keep reporting earnings and showing they've been very strong. Consumer spending has continued to be strong. When you look at the debt balances, so like amount of credit cards and things that consumers have, none of that's at concerning levels by any means. And I think you want to take all of this in an aggregate. And I think bigger picture speaking, there's a lot more positives on the economy than negatives right now. And that's what I would take.
You know, what's funny, actually, I've been doing a lot of annual reviews recently, and I point out in everybody's performance report where things dipped in April. And I'm like, do you remember what happened in April? Nobody has any remembering of what happened, like the tariffs coming out. Nobody recalls that.
And nothing like a V-shaped recovery, Chris, to block everybody's memory.
Exactly.
Well, I said the two shortest memories are about weather and markets, right? People always forget what the weather was like, even like last year. You can remind them and say, no, it wasn't that way. I'm like, I'm pretty sure it was. But Bob, I mean, what do you think here? Do you think that the economists are right? We are getting a real soft patch in employment that is a real risk to the economy, that we're going to see employment fall off a cliff here? Is that a realistic expectation?
Well, it's always a risk. I don't know if it's a realistic expectation. The way I see it is that the employment situation is just more in balance, right? There's a lot of employers who are holding off on hiring simply because of the unknown of AI and what the impact of that's going to be, and the impact of tariffs. We don't ultimately know what their fallout's going to be, if any, and in supply chain. So I think that I think it's going to be a productivity-driven market. So profit margins are going to be really critical. And I think that's kind of what's been happening with these tariffs. I think a lot of companies have been eating them as opposed to losing market share. So you can only do that for so long. But I think that productivity increases, profit margin increases, the earnings estimates keep going through the roof. So that's what really drives markets, in my opinion.
I try to combine Chris with AI, and I'm not seeing the results, Bob. So I'm not sure what's going on here. He thought he'd be more productive, but he's just sailing more. I don't get it.
You know what? AI can't match my sense of humor and charm. So take that for what it's worth.
Courtney says it does it better, but I don't know. Well, honestly, our business is a microcosm of this right now, right? I mean, we needed a lot of people to do our proposals, right? We need a lot of effort from our team. And right now we're looking at a software program that does everything that we were doing essentially manually, doing automated right now. So by buying that software, let's say it costs $15,000. Well, what is that going to save us in the man or woman power of someone actually going in and manually doing those proposals? And we do a lot of business every year, right? We do a lot of proposals every year. The time that's going to free up for, our administrative team or operations team is significant. And I think right now, every company's more focused on efficiency and increasing their margin. And then once they do that and they get that increase, then they're going to start to look to hire again. I don't know. What do you think, Courtney?
Yeah, that's the interesting thing to see about the labor market. So all of this data, remember, is backwards looking. We're seeing what's been happening the last couple months. So when you have companies who aren't sure what's happening with tariffs, so you have no idea what your input costs are going to look like, you're not going to be hiring. But also, yeah, how can you implement AI, which means that's less people I need to hire moving forward potentially. So you're in kind of this no hire, no fire place right now. So it's not that you're seeing a lot of layoffs, but also you're not seeing a lot of hiring because everyone's just in a standstill right now. So I don't think that's necessarily a big red flag for the economy. I think this is people trying to shift and really reevaluate their businesses to see how can I make it more efficient before you're actually going out and hiring. And you actually are starting to see productivity numbers are picking up a little bit. And I don't know if that's attributed to AI or not, but I think if we continue to see that, I think that'll probably be a trend that happens.
Hey, hope you're enjoying the most recent episode of the Payne Points of Wealth podcast. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million for your retirement, Bob, Chris, Courtney, and I will run for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We'll go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life and hone in on every financial issue you need to address today, whether it's an income plan for retirement. How do you take Social Security? How do you draw from your portfolio, factor in inflation, and don't run out of money? We'll look at diversification. Markets have been wild over the course of the last couple of months. Has your portfolio been up and down? Or have you been sitting in cash, CDs, money market funds, paralysis by analysis? We'll put together a full investment game plan. We'll show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products, whether it's an annuity, mutual fund, insurance product, structured product. We'll do a deep dive of every investment you own. We'll show you how to reduce the cost and optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get a full tax playbook, and we'll do this full review at no cost. We'll literally go through everything for you, do all the work up front. Simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review. One of the biggest trends on Wall Street right now is you're hearing about the democratization of alternative investments, which sounds amazing, right? We're hearing about how you can own private credit, you can own private equity in your 401k now, and you're going to get access to all these investments that only institutions could have before. So, Bob, is this the greatest thing since sliced bread? Should we be excited that now we can invest just like those big institutions and endowment funds out there? What do you say?
Well, Ryan, it would be like me taking you to Vegas today to play in the big poker games, right? If you don't know who the patsy at the table is, well, then you guys know the answer to that, right?
Probably you.
Are you saying Ryan's the patsy?
I'm saying anybody who thinks they can go up against professionals who are giving up on this market and actually get a better return. I think that that speaks volumes.
Well, I think, just at face value, right? When it comes to some of these alternative investments, very opaque. Meaning it's hard to get information about these investments, right? It's not like public companies, all the information's public. And there's a lack of liquidity, right, Courtney? Like the great thing about buying Apple stock is it trades on an exchange for, whatever, 8, 9 hours a day, and even after hours if you really want to trade it. Whereas a lot of these alternative investments, very hard to sell them once you buy them.
Wait, Rye, say that again. You said they're two variables. They're actually two constants.
Yeah, and especially it depends where you are in your investment journey, but especially if you are like in or nearing retirement, you don't want to be locking up your funds. Like if you are in some sort of need where you need to access your funds unexpectedly, these kind of investments, you just don't have the options oftentimes of getting your investment. So I think that is absolutely something to consider when you're looking at these, but we like more liquidity, not less, especially as you're getting into retirement and need your assets.
Well, going back to the Patsy too, Bob, and never mind the fees, right? I mean, if you look at the fees of owning an exchange traded fund or buying stocks, buying bonds outright, the fees are almost nothing. And meanwhile, these alternative investments, when you start going through the prospectus and you have to go way to the back of it, the fees tend to be extremely high on these type of investments.
They're extraordinarily high. But, it just comes down, just think about the economics of our business. If you're selling these investments, right? If you're the top salesperson or the top company selling these investments, isn't it easier to sell the entire product if you have to make one phone call or you have to make a million phone calls, right? So the fact of the matter is that they're going to these small 401k accounts to sell this stuff. Tells you, speaks volumes. It means they've run out of all big money. They're overweighted in this stuff. And they're throwing it up now. They're selling it. They're not buyers. So, that should tell you something, just from a base instinct as an investor is like, why are you being so nice to me all of a sudden?
Well, especially as all the big institutions are selling, right? Like Yale, who was one of the big institutions who kind of pioneered getting into alternative investments. They're selling their investments and they're trying to spin it of like, oh yeah, we've done really well. We're just taking some profits. But I think you do have to question when the institutions are selling, now suddenly it's on sale for the retailers. Is it because they're selling and then they're just trying to find these new buyers? I think that's the question.
Yeah, don't run towards that burning building. But the other thing too about the perspective is, and Dad, you've seen this a lot of times. You go through there, and there's always a section in small print that says you could lose all or most of your principal.
Yes, that's always a buzzkill, Chris. And it's really tough to sell a product when you have that highlighted in the prospectus. But to get back to what you're saying and what you guys are saying about fees, there is a silver lining here, right? And again, it goes back to our basic philosophy of owning only things that are liquid, not having anything that generates a K1. But who makes money here no matter what? Are the companies like Blackstone and BlackRock and KKR who are issuing these products. They get paid every year, no matter what happens. So, don't buy their products, buy the company. And that's why you want to own an ETF that has financials in it, because they're all going to go up and they're making a lot of money. So you should make a lot of money side by side with them by not being their client, but by being an investor.
So Bob, don't trust Wall Street. Got it. Wrote that down.
Never.
They're not working in your best interest. And
ever.
I think, ever. Yeah, exactly. Ever. And, everything that's private right now, right? If it's private equity, it's private real estate investment trusts, it's private credit. And that's basically you're lending money to different organizations that may not have a stellar track record, right? That you're lending to, almost like what we would call junk bonds. And I think, one good rule of thumb here is you're not getting rewarded for the interest rate or the risk that you're taking. The interest that you're getting paid right now is some of the least amount in history. So it's like I can lend to the U.S. government over here. They've got the printing press, or I can lend to some company over here that is having financial trouble. And you're really not getting that much more interest from those companies, but taking on a lot more risk. I think that's one of the biggest problems right now, Chris.
What I would want to know is why would you do that? If you can get a treasury where it's backed by the full faith and credit of the U.S. government, there's a better shot of you getting your principal back plus interest. Why would you chase that riskier thing? And I think, that comes down to just the average investor just really not knowing exactly where the risk is.
Well, first of all, guys, they use fancy names like private credit. Back when I was your age, they called it loan sharking.
Or business development companies. That's my favorite. It sounds like you're going to go to a workout.
I mean, some of these companies, there have been some defaults. Let's face it. There was a company that was lending, to people who weren't accredited, lending money for cars that went out. They went down spectacularly very quickly. They borrow like $2 billion, they're gone. So there is a default risk rising, but there are actually companies out there that can't even pay the interest on the loan, they're issuing PIKs, payment in kinds. It's an IOU. I don't know about you guys, but I want to start paying my bills with IOUs.
Well, it reminds me of the movie Dumb and Dumber, where they took all the money, right? And basically they said, "Where's all the money that you took from us?" And they said, "No, we have all these IOUs. They're just as good as money. We're going to pay you back as soon as we can."
Well, guys, we're swimming in abundance right now. There's so much liquidity. There's so much speculation right now. We're seeing SPACs make a comeback. We're seeing every iteration of cryptocurrency being invented. Everybody's using the micro strategy, borrowing money, zero coupon bonds, and then borrowing Bitcoin. I mean, creating a Bitcoin reserve. There's 200 companies doing that now. The question I have is, why doesn't everybody remember the recent credit crisis, right? The credit crunch. How is that all forgotten so quickly?
Yeah, I can tell you why, Bob, because you have two generations that didn't experience it. Bob and I just happen to be older than everybody on this podcast. So we lived it. And Chris, you kind of came in. What year did you come into the business?
2011, but I remember being in the office with you calling clients every single day. I think you still have the scars on your back.
But it's a great point, right? And it just seems like, Courtney, over and over again, Wall Street loves to entice you with those high yields, right? You can get 10%. You can get 12%. But, as we've learned on Wall Street, in my experience, there's no free lunch.
Yeah, even if something seems too good to be true, it probably is. And they're going to repackage it. You use the word high yield. That's just a junk bond. If you're a high yield bond, it's just a lower quality bond. There's an extra risk that you have to take in order to get higher income. You always want to figure out, what is that risk? Why am I getting something better than something that's safe? And so if you are, there's a reason behind it. And that's what you want to figure out, what that reason is.
Bob, do you want to have something called a junk bond in your retirement portfolio that you're going to depend on for the rest of your life?
Well, first of all, bonds are a bad word now because they don't go up as much as NVIDIA. So, there are investors out there who conflate the two for some reason. But, let's face it, bonds, they're a separate asset class. And, and with bonds, you never make money. Right? You make interest. And even if your bond goes up in value, what happens? A bond comes due, you recapitalize that yield in a lower coupon bond. So it's all you make is yield. So you never want to lose money in bonds, right? You can't make money in bonds. So don't lose money in bonds. I love that full faith and credit the U.S. government backing our bonds.
You know what, Bob? It goes back to one of your old adages that more money has been lost chasing yield at the point of a gun. I think no time like now is more apt than ever for that Bobism.
Yeah, it's so true, Rye, because, people get sucked in by yield, right? They hear 5%. They want to put everything in a treasury bill. 8%. I want to have a private REIT because it pays 8%. They get fascinated by that coupon or that yield, which is sometimes not real. A lot of times it's not real. One of our major tenets of the Payne Principles of Wealth is never, ever reach for yield.
Thanks for listening to the Payne Points of Wealth. Hopefully, you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Payne Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.